Good morning from Muncie, Indiana on a nice rainy Saturday morning, and welcome to Amendment 651, College of Business. This morning we're very fortunate to have as our speaker James Schrecongost, who is a Ball State graduate, also an MBA from Ball State. A little background on Jim. He is the past president of the College of Business Alumni Association. He has been a lecturer at Rutgers University and at the American Bankers Association. Jim is president of the American National Bank of Muncie, Indiana, as well as the chief operating officer. He is a non-traditional banker. He doesn't wear a green eye shade, and he is very controversial. And that's why it's always a great pleasure to have him, because he tells it as it is and not in fairyland. Please welcome Jim Schrecongost.
Good morning.
Good morning.
Thank you, TJ.
Yeah.
Really appreciate the opportunity to speak to you this morning and share some experiences. It's kind of unusual that a banker would be speaking to a production management graduate class, but maybe after we go through this morning a little while, you'll understand and get the idea that what we in the financial services industry do, what those of you in manufacturing do, are not all that different. We just work with different commodities, perhaps. This morning was kind of an interesting experience, being whisked away by the Ball State limo, brought over here to the Studio 1, which is nearly filled to capacity with students and town folk. Spending an hour in wardrobe and an hour in makeup, getting ready to do this production. And then having a fine introduction, TJ. Thank you. You read it just like I gave it to you. You always come in here with some degree of intrepidation because you don't know exactly how the audience is going to react. But I feel a lot more comfortable now because one of the participants in the audience handed me a news clipping this morning that she said was apropos to my being here. It says, "Being dull has some advantages. Dull people may not be the first invited to parties, but they are usually the first in line for a promotion, according to a research team at a medical college. The team made a study of 88 executives and found those people with low pressure capacities make the most successful executives. This is because they can concentrate on their work without being distracted by small talk, beautiful sunsets, or smelling the roses. Executives who are categorized as fun-seeking tend to have lower salaries, fewer responsibilities, and more complaints." And I'd like to thank you very much for that article. Something I'll treasure for a long time. Let me explain to you this morning a little bit about the financial services industry. If I use the word bank, please use that only as a definition of a commercial banking system. I don't consider myself a banker. I'm not sure what a banker is any longer. I do consider myself a manager in the financial services industry. But so you'll better understand some of the changes that are going on within that industry and how those may relate to those of you that are in manufacturing and production. Probably a brief review of where we've come from, where we are, and where we think we're going might be of some help. First of all, the view of the banking industry, BD as I refer to it, BD standing for before deregulation. There had been a need within the banking community at that point, who were the primary financial intermediaries at that time, and that may not be the case today, but there was a need for severe regulation. There were bank failures, there were lack of public confidence, and basically Congress in its infinite wisdom decided that the best way we can make a strong banking system is by putting in a lot of rigid restrictions. And if bankers can operate safely within those restrictions, then the institutions will be safe and sound, and therefore confidence will be retained. Capabilities of management during that time were not as great as they are today. In those days, if you were honest, if you were literate, you could get along just very well. The training wheels were on the financial bicycle, and it was pretty difficult to fall off. Well-managed banks made a lot of money. And poorly managed banks made money because that's what the system said we wanted. Safe financial institutions. A lot of banks, particularly community banks, which is my frame of background, were family owned. It was an industry that was characterized by little initiative, little creativity. There were usually a few bright people in each organization and a lot of other people that helped get the job done and turned to cranks. Earnings were assured by the regulatory system. We were told how much we could pay for our inventory. That is, we could pay nothing for checking accounts. We could pay 2 or 3 or 4 or 5% as time went on for savings accounts, and we had some restrictions on what we could charge for our services. Earnings were therefore pretty much assured. Banks made their money, more than 65% of their revenue in those days, from loan income. So we entered into an awful lot of lost leaders to lure the general public into our banking institutions, have them be customers with the hopes that pretty soon we could loan them some money and therefore cover our expenses. We got to doing everything as a lost leader with the exception of loan prices. Well, that went along for a good while. And now we come to point 2 on your agenda, which is dynamics of the financial industry and transition. Finally, we decided if we're going to deregulate air traffic, if we're going to deregulate trucking, we ought to deregulate the financial services industry. The thrifts were growing, the savings loans, mutual savings banks. Other financial intermediaries were entering into the marketplace, and it appeared that they were going to operate under different rules and different regulations than the commercial banks were going to operate under. Congress went into a 6-year deregulation mode with some rather sweeping financial legislation a few years ago, the last leg of which will occur in January of this year. Recognizing the need not to promptly change the legislation, the rules that we had always played by and that we had learned to operate by, that's why there was a 6-year gradual work into the deregulation mode. It was Congress's thought, I suspect, that if we change the rules tomorrow, many banks will shoot themselves in the foot, will not know exactly how to compete as industry has had to compete, and that is in the marketplace without all of the rules and regulations and restrictions that had been imposed on us for years before. Competition takes several forms. One of the reasons why back in the old days we did not have to be as market-driven as we are today was because we were department stores of finance. It's a frequent cliche that was applied to banks. Savings and loans, thrifts, credit unions, those people that we know today and compete with could not offer checking accounts. Therefore, we had a captive market. We didn't have to be marketing oriented. We did not have to be market driven. All we had to do was be open. We were the only person that could provide those services, and therefore the money poured in. Recognizing that competitive disadvantage, the thrifts were always allowed to pay 1/4% more on their deposits, their time deposits, and therefore they started acquiring a deposit base. They also were financing the predominant share of real estate mortgages for the purchase of homes. If this is the market, where it be local, regional, or national, this market perhaps, and please don't interpret these pie shares to be accurate, they're only for example. What has happened is this used to be our marketplace. These were the checking account dollars, these were the savings dollars, and these were the loan dollars that went to business and to consumer purchases. All of a sudden, what we have is we have the thrifts, which are the savings and loans, who now have full banking powers for all practical purposes. They can offer checking accounts, they can have trust powers, they can make consumer loans, they can make commercial loans, they're in the payment system. For all practical purposes, they are banks, as we have traditionally known them. Over here, and these are my favorite folks, are credit unions. And the reason they're my favorite folks is because they have a good thing going. That is, captive market for most purposes, a heck of a fine delivery system through payroll deduction, both for deposit gathering and loan servicing, a tremendously small overhead in terms of people, bricks, mortar, and those kinds of things. But we notice something very interesting happening in the marketplace. And that is, sometimes you don't know when you're well off. We start to see the credit unions being more bank-like, quote unquote. That is, reaching out, building new brick and mortar, adding personnel and overhead, and reaching out geographically. Pretty soon, these people have always been what I call nichers. They found a niche in the market that wasn't being served, found a way to serve it more efficiently than traditional banking and financial institutions were doing it, and did well. Now there is a less and less difference between these folks and the rest of the financial intermediaries. That is, if they continue to expand their area of reference and therefore get into the brick and mortar and personnel costs that we incur, pretty soon they're going to be just like us, and maybe that niche won't be as predominant. And maybe they won't be to operate with the same efficiencies they have been. Interesting concept to watch evolve. Over here are another group of folks. They're the brokerage houses. They're predominantly upscale customer oriented. They want the people who trade in equities, who trade in bonds, and as a result, a way to get those folks in, they're offering bank-like services. Margin accounts, traveler's checks, MasterCard, Visa, and some draft privileges, or checking accounts as we commonly refer to them. Down here are the insurance companies. Insurance companies are one of the prime term lenders to business, the big ones, Prudential and some of those folks. Not only are they prime term lenders to business, but they are also very active, of course, in IRA accounts, in self-employed pension trusts, and various other financial services. Over here we have the traditional finance companies, commercial and also retail finance that you recognize. You drive up and down the streets, and as you watch Joe Garagiola and other people on the tube. What has happened here is that, and once again this is not proportional, the commercial banks, as we referred to them, have seen their market significantly segmented with different financial intermediaries appealing to different financial needs within that overall market. We used to have this market and we don't have it anymore. At least not in the percentages we used to have it. A couple nice things happened during this period that has been a result of deregulation. When I say nice, I mean nice because they forced us to change the way we do business. Historically, 10, 15, 20 years ago, our inventory, our dollars that we take in, that we lend and invest, that we pump back into the marketplace, were 70% in the form of checking accounts, which we refer to as net demand deposit accounts, and 30% in time money, which are savings accounts and other things. And these were relatively inexpensive. 4% savings, and then we got into the CDs that had a little longer maturity and were fixed in amount, and we started paying 5 and then 6 and then 7 and then 8 and whatever the regulation and the demand was for those services. That's where we were. This is kind of where we are. Today, in most financial institutions, of course there's some variance, we're looking at maybe 15% and 85% in time deposits. Through deregulation now, basically the ceiling is removed, or soon will be removed, on all forms of savings deposits by regulation. Those are going to be priced by supply, demand, competition, those kinds of things. Not only has the proportions changed, which meant that our free, quote-unquote, money has dropped significantly, but the money that we pay for in the form of interest, the price has increased significantly. Our cost structure has just changed. Not only has the cost structure changed, but the pricing volatility has changed. Back in these days, these time deposits were fixed rated. They were regulated that way. They did not change. They were not subject to change. And of course, back in these days, nothing changed. Prime changed maybe once every couple, 3 years, and maybe it changed by 1/4%, but that was all. Today, these dollars are virtually repriceable within a 6-month period. Some of them daily, some quarterly, some monthly, but by and large, the core deposits of today's banking system are repriceable almost daily. Now, in industry, when you buy your inventory, you pay for it, and the cost is fixed and it goes through the manufacturing process. In the financial services industry, that inventory changes every day. So our income has to change almost every day in order to maintain the kind of margins. To be contrasted with the retailer, he buys his inventory and those items go on the shelf. They stay on the shelf and consume capital until they are sold. Every day, a well-managed financial institution sells all of its inventory to somebody. Every day, at whatever price can be acquired. He sells it in the form of loans. He sells it in the form of investments. And most banks are somewhere around 90% in the form of earning assets, with the other being in cash that maintain to take care of the currency needs of their customers, brick and mortar, equipment, that sort of thing. But by and large, most banks that operate well are somewhere in the 90% range. This has caused all kinds of earnings pressures. No longer can we afford to loss leader everybody with the idea that the loan customer is going to have to pay the freight. Because quite honestly, competition and the increased cost makes it too large of a burden for the loan customer to carry alone. So you see a change in the financial institution's business. Things that used to be free and were loss leaders are now being priced. There are all kinds of consultants going around helping financial institutions cover this new increasing cost that are doing seminars and other things. Some of them even have taken on the cliche that if you have a service in your financial institution and it moves, price it. Don't do anything for free. Everything gets paid for. Well, those of us in business know that that's a little easier said than done, but the concept may be somewhat valid. The point is, with this shifting cost, the shifting way in which we're doing business, the demands on management are exceedingly heavier and more demanding than they had been before. We now have to compete. We now have the unique position of making decisions that can cause our institution to prosper or to fail. The media has had a heyday on financial institutions that have had their problems, whether they be Ohio Savings and Loans, whether they be banks in sleepy Oklahoma City, whether they be mega banks, or whether they be the bank down the street. It really doesn't matter. It's problems, earnings pressures. Those are the demands of management. There have been a couple other changes that we now have to contend with that were never there before. Legislative. Not only has competition changed, but all of the legislation has changed. Not only on what we pay for our product through deregulation, what we can sell our product for through changing rates on loans and other things, but through the way in which we structure ourselves. There are some laws that prohibit formalized nationwide banking. And I would be remiss if I didn't tell you that the laws are one thing and practice is something quite different. Anyone that believes there isn't nationwide banking today hasn't really been alert to what's happening in the marketplace. A good example that I might give you about that is One story that I had related directly that I can attest to is that there was a loan production office in San Francisco that was a branch outreach of the First National Bank of Chicago. It didn't take deposits, it didn't offer the services, it was a loan production office. That is to say, its sole purpose was to develop loans that would be financed and funded from Chicago in California. That calling officer called on a very fine prospect out there and said, "I'm from the First National Bank of Chicago," and presented a financial package. At that time, the company was also being solicited by several California financial intermediaries, who I think took the position that we can respond and react to this customer's request much faster because, after all, we're here, we're located in the marketplace, and we all recognize that the Chicago guy has to get the information, assimilate it, analyze it, jump on an airplane, fly to Chicago, go through the process of having a loan approved and funded, return, close the loan, and therefore we must have at least a 2-week head start. What actually happened was the First Chicago officer left that customer with the requisite information, telefaxed it from San Francisco to Chicago, was approved the next day. The documents were therefore telefaxed back. The gentleman was in the customer's office within 2 business days to close that financial transaction. Now, can he take deposits? No, he can't. But as soon as that customer, I'll guarantee if he did his job, makes a deposit in that San Francisco financial institution, those dollars are going to be electronically transferred to Chicago, Illinois. Is that nationwide banking? Not in theory, but it sure is in practice. There are people in Muncie, Indiana right now that are doing business with banks both on the East and West Coast. There are local corporations that are solicited on a regular basis from some of the larger regional and money center banks on a weekly, monthly basis. There is nationwide banking. So that legislation is going to tumble, and it's going to tumble gradually, just like deregulation did in my view. But once again, we're not going to change the rules too drastically because of the knee-jerk reaction that sometimes we as bankers seem to have. There is a new concept that you may be plugged into called regional concept for banking, which is based on reciprocity agreements within state local areas, basically geographical. There's an East Coastal region, there's a Midwestern region, there are Western regions, and so forth. But basically the Midwestern region is Wisconsin, Michigan, Ohio, Indiana, and Kentucky. Now, if all of these people have promulgated legislation that allows for reciprocity between each and any and all of these states, all of a sudden we have a 5 multi-state area that has a financial capacity there. And one of the primary reasons is it's a defensive measure to allow goods and services to be delivered on a cost-effective basis that can compete with the larger financial institutions, the money center banks primarily. On a state basis, thank goodness, on July 1st of this year, Indiana entered the 20th century. We decided that the world did not end at the county boundaries, that there was a universe out there beyond the county. And so what we've come from is a banking situation in Indiana that says banks may not branch beyond the county in which their head office is located, to an expanded banking bill that says you can branch contiguously, you can form multi-bank holding companies and therefore have more than one bank under a corporate structure. But we see that this organizing restructuring has taken place so that we can offer services. The best example I can give of how this can be affected is that let's look at the local Muncie economy and the local Muncie market for financial institutions. There are 6 primary financial intermediaries in Muncie, Indiana. One is a mutual savings bank, one is a savings and loan, and 4 are commercial banks. Each of those commercial banks operating within this county have data processing needs and capabilities that they pay for. Investment officers, therefore data processing officers. And you see, what we're talking about really is a duplication of services and goods and costs. there is going to be a consolidation of financial resources in this country and in this state and in this locality eventually. We don't know when, but it's got to happen. After all, how many automotive manufacturers are there in the United States? The capital requirements are tremendous, and now because of these cost pressures, the things we've been talking about, the earnings pressures say we have to be more economical. We are not only dealing, and on this pie chart I showed you a while ago, with financial bank competition, but we've got non-bank financials. And they come in different packages and different sizes, and they're doing different things. And we could go on with that. Not to mention the brokerage houses that we already talked about that have national distribution systems. But here's one. Their mission statement has probably changed from being America's retailer to being America's financial services department store. It is quite possible to buy insurance, make investments, finance various appliances, financial consulting, in addition to buying goods and services that go there. Even health care is being addressed in various forms in some of the Sears stores. Now, from a competition standpoint, if I cannot branch beyond Delaware County, or if I cannot organize within a corporate structure beyond a multi-state area, here is a financial competitor that already has a branch in every reasonable sized community in the country. And through electronic terminaling and through plastic cards in the forms of consumers, a very real competitor with a distribution system that, because of the financial size of this non-bank competitor, it would make it very difficult for community banks and other banks to compete because of the service delivery system, not because of any other feature, but just the service delivery and the capital requirements to be competitive. Those are some of the challenges that we are looking toward. Well, if we're having all of this change and all of these challenges and opportunities in the future, what are we going to do? How are we going to approach these? One of the clues is something banks didn't have to do before, because once again, things didn't change much, is a new concept of banking, one that has been available to those of you in manufacturing and the corporate world for a long time, and it's that concept. And I would submit to you that that is going to be the difference for many people in the financial services industry between survival and non-survival, between being mediocre and being excellent, between being profitable and being very profitable. Many of us have spent a lot of time in this area. Some corporations, of course, have whole departments that do nothing but plan for their organization. Community banks, such as the one I represent, because of our size and because of our personnel requirements, because of our marketplace, have not at this point allocated personnel dollars to strategic planners. That's why the emphasis is on management in commercial banks, in savings and loans, and other financial intermediaries. Because it's that management that has to break themselves out of the old mindset that said everything's regulated, nothing's changed, I can hardly wait to get back to the good old days, because there are no good old days to get back to. This is normal. This is today. This is what we have to deal with. And strategic planning is going to give us a framework from which to make current decisions that are consistent with long-term objectives and goals. And those people that don't do this are unfortunately going to find themselves in a very uncomfortable position as time wears on. We have alluded to management requirements. We have alluded to differences in competition, regulation, marketplace, technology. Therefore, And those of you that are in here, and this is not a big pitch, so we'll keep this relatively short as compared to some of the discussions that I have with underclassmen. Career opportunities in the banking and financial services industry. It is absolutely a wonderful time to be in this business. There are things happening, there are challenges, there are opportunities, new ways of doing things, technology. Many of the folks that have been in the banking business are having a little difficulty in adjusting after all. They have grown up in an industry that had no change and been plummeted into the 1980s that is all change. You will find responsible young people in responsible positions in today's better managed financial institutions. Before, there was the old stereotype about, first of all, if I went to work in a bank, the only way I'm going to evolve and be promoted is if Uncle Fred owns the bank, or if someone dies, or if someone gets fired, or whatever the case. It's the only upward mobility there is. And back in the old days in banking, I'm sure that promotions and compensation and opportunities and benefits were all based on hash marks on one's sleeve, not what one is willing to produce. That is no longer the case in well-managed financial institutions. People are being recognized for their ability to contribute, not necessarily on their effort, but on the results that are produced. I have seen calling officers from major banks that are tremendously youthful in their appearance, mature in their judgments, and informed in the business that they represent. It's a tremendous opportunity within this industry now, particularly as the bankers have to evolve into the marketplace and hire and compete with industry for the sharp young people in order to do the things we've been talking about. Innovate, deliver, be market driven, have a different mindset. There are some things going on within the state of Indiana that I think are refreshing. Haven't gotten a lot of publicity yet, but some things you need to be aware of. M&A, as the corporate people refer to it, mergers and acquisitions, those things are taking place. There are currently, as I understand it, 20 pending applications with Department of Financial Institutions for some consolidation. We have seen some announced in the news media where the various larger banks have acquired some other banks, and all of those to date have been on what we will call friendly basis. They have been on relationships that have ensued over the years that have become logical to form relationships. Some have been on defensive basis. One bank I know announced that they were merging with a larger institution because a different larger institution had acquired a bank in their own marketplace. And the only way they thought they could effectively compete was to also become a member of a larger organization. Many of those decisions are based on the management potential within that bank. Age, ability, the ability of the institution to acquire and recruit and maintain capable, competent people. In Marion, Indiana, as an example, the American Bank in Marion announced that they were going to align themselves with SumCorp from Fort Wayne. It was just on the back page of the Wall Street Journal. The First National Bank of Marion is going to align themselves with Bank One of Ohio. So in that community, already there have been 2 changes in control, or will be as soon as those things are followed through and consummated. But all of a sudden, there are now 2 different corporate structures operating. What makes this interesting is, in each individual marketplace, there is the opportunity to say we're going to compete by being larger and being plugged into a different system. There's also room, in my view, for the independent, locally owned and locally operated bank to stand right next to a rather large holding company outfit and compete rather effectively. But it once again goes back to that concept: management, management, management. Those are the keys, as I see them, to the future of being successful. Innovation, being market-driven, being technologically aware, and, to a little larger degree, being risk-takers, something bankers really haven't had to do very much of before because the regulation had put us in a position where we didn't have to take much risk. When we did take risk, we took it in a loan account. And of course, you're all familiar with that old cliche that if you want to borrow money from a bank, only those that don't need it can borrow it. We could spend an hour or two talking about that concept, but it's really not all that mundane. The point is, today's and tomorrow's financial executives have got to be willing to take some more risks. How much is a matter of function and capital and ability. But after all, sometimes we in business, whether you're in financial institutions or whether you're in production and manufacturing, tend to go through a system that we call paralysis through analysis. We study things to death. We cannot make a decision. We don't want to be wrong. Well, nobody wants to be the president and chief executive officer of a successful company and have the reputation of being the person that took it down a tube. I recognize the risk. However, I would say to you that if you bat 500 in the National League, you're going to be on the All-Star team. And that's just 500. We will find that there are some people in this business that are willing to take some risks. There will be some rewards and there will be some disappointments. But we are going to change that philosophy a little bit. Those of us that are in community banks, and community banks by definition are primarily locally owned and locally operated financial intermediaries that are oriented to a regional locale, whether it be a county, multi-county, or a local city kind of environment. They take their deposits from those sources and they reinvest those deposits back in those communities for the most part only. That's contrasted with the large regionals and with certainly the money centers. We don't do very much alike with the money centers. They have different sources of funds, different income sources. What I have been impressed about large banks is that basically all they do that small community banks don't do is make larger mistakes. And that's not meant to be glib, and it's not meant to be put down. But by and large, the most profitable banks are the local community banks. When you look at companies, banks that fail because of oil loans, that have loans to developing countries that are equal to or greater than their capital, one has to question the management and the continued operation of those companies. What do community banks do? Here's a strategy, for instance. If we're operating in Muncie, Indiana, and a large regional multi-bank company either acquires or starts de novo a new operation in Muncie, do we quiver in our boots? Do we give up? Do we ask somebody to buy us out? Those are various alternatives to the question. I think what you will see, and by the way, it has been said by various doomsayers, that the future for community banking is limited. That eventually there will be, maybe across the country, 3,000 regional banks. There will maybe be 20 international world money center banks, and there will be fewer community banks. I don't know if that's true, but I would take a very strong position against the future of community banking. See, there's one thing that we do as community bankers better than anybody else. And I'm talking about the well-managed community banks. We do this better. We manage relationships better than the larger ones. If I am a businessman and I'm in production and I am concerned with financing my company, I want to deal with someone that's local, someone that's going to be there, someone that has an interest in the community, someone that I can go in and sit down to and talk with and share my problems with, someone that can be responsive to my requests and can give me a quick answer if that's what's necessary, not a transient branch managership that is operating from a position where the authority is in Dayton or Lexington or Louisville or someplace of that nature where those folks may or may not have a sincere interest in the local community. They have a financial interest in that community, certainly by the fact that they have an institution located there. But the relationship part of banking is going to be the key, in my view, to the profitability and the survival of community banks. Being able to talk to the customer, responding to his needs. There are 5, 6, 7 areas that I have found to be especially helpful so far in my career, and I just want to share them with you because they're so applicable, whether you're manufacturing, whether you're a retailer, wholesaler, or financial institutions. And for lack of anything else, we'll call them KRAs, which stands for Key Results Areas. There are only really 7 of them. If you can think of others, it's perhaps a byproduct of 2 of the ones that are listed in that 7. But first of all, productivity. Something we didn't be worried about, or didn't have to be worried about very many years ago, either in industry or in financial institutions, because we had the ability at that time to sell our goods and products and services to the marketplace. We did not have to be efficient. We did not have to be excellent. There was only lip service paid to quality because we were able to cover the cost by increasing the cost to the ultimate consumer. That bubble has burst, as you all know, and all of a sudden there is a regeneration of conversations and planning about productivity, quality circles, Theory Z, Japanese form of management, bottoms-up strategic planning, other concepts, all dealing with productivity, technological innovation certainly. Several years ago, and I will share this with you since it's a matter of public record, in our little community bank, we had 134 full-time equivalent employees. We were able to earn in the bank net after-tax profits of $1 million. The first year we ever earned 7 figures. It's not important a year, it's only important in the concept. I would tell you that this is less than 5 years ago. In the near future, and it's not important whether it be this year or next year, we have the propensity, the potential of earning net after $2 million. Those of you that are in the audience, would anyone care to venture how many full-time equivalent employees we have today? Take a guess. It doesn't cost anything. Just guess. Go ahead. Pardon? The same. We have one vote for the same. 1/2 as many. 100 from the cheap seats over here in the wings. Well, the fact is, we have somewhere in between all that, we have 127 full-time equivalents. Now, certainly we have invested capital in the form of systems. Computer, microcomputer, satellite disk on the roof with microbeams bouncing around and all kinds of things I call Star Wars inventions. But we have less people producing twice as much bottom line for the shareholders. Are they working twice as hard? What do you think? No, they're not working twice as hard. They may be working twice as smart. They are better as a group than their contemporaries over here of 5 years ago. They are more professional, they are more intelligent, they are better trained, they are more productive. Are they paid better? Yes, they are paid significantly better. Not only in the form of salaries, but in the form of bonuses, incentive compensation, key to bottom line productivity, key to sales efforts. These are things that were not heard of in financial institutions a few years ago. I'll relate one quick story and say, does this work? And sure it does. We unfortunately suffered the misfortune of having one of our branch operations robbed this last year. And when senior management group arrived and the various authorities were running about, fortunately no one was hurt, the question was asked, did the money that was stolen come out of our bonus? That was not the manager of that branch that asked that question. It was one of the teller people, one of our frontline people. When you get your organization down through the ranks, thinking bottom line net profit, productivity, that's where the real solutions and answers came from. We could not have paid bonuses to our employees. We could not have produced a return on investment to our shareholders had we not had the excellence and the productivity that we have. It's a concept that is as live and well in your industry as it's starting to become in ours. Customer satisfaction. Once again, back in the old days of deregulation, hey, this is it, take it or leave it. You can't get it anywhere else, so you must have to buy it here. It's a lot like going to a, without singling out anyone, an operation that may have legal consequences. It's the only place you can get that particular service. You don't find the customer-oriented satisfaction that's there. In terms of customer satisfaction and some of our competitors, I would think that if we could not successfully compete with Kmart, we ought to quit. We ought to be fired. Because every time I go through there and I hear someone say, thank you for shopping Kmart, I know they don't mean it. And you know they don't mean it, because they say it to everybody. And we all know that that person that's standing there punching that machine, bless her heart, is doing what she was told to do. But she gets paid the same whether she rings up 1,000 people or one. Do you think she really says thank you for shopping Kmart because she means it? And that's the difference. Getting people to be involved and enthused in what they're doing and proud of what they're doing and take an interest. Economics. Just the pure hard bolts things you study here. How do I produce it better? How do I produce it with less expense? How do I become more efficient? How do I increase sales, increase share of market while reducing marginal costs and total cost as a reduction of fixed cost and variable? Those kinds of questions. Effective people. And I'll be the first to tell you that our organization operates, like yours, in a very, very competitive environment. It is not a captive market. It's a transitory market with all kinds of changes. But if we did not have effective people, and if your organization does not have effective people, you will not enjoy the kinds of results that we're all interested in producing. That, in my view, is a difference in any organization, whether it be one of the Fortune 100 or whether it be the smallest mom and pop shop in this company or in this country. It's the people. And how effective are they? How good are they? How interested are they? How enthused are they? You know, business is supposed to be fun. If you've seen that movie, the cassette, Passion for Excellence with Tom Peters, he brings out a point. Those people that enter various business schools have to go through a big sign that says, "Thou shalt never smile again." American business is serious stuff. It's not supposed to be fun. But the people that do the best, in my view, are not the dullest, as someone insinuated earlier. They're the people that have a zest for what they do, that have fun in what they do, and that have those loose, tight qualities that In Search of Excellence talks about. Organizational climate. That is more affected by actions, I suspect, than by the policies and memos that we crank out as managers of our various and respective firms. We say one thing and we act another way. If we treat everybody as Theory X, I think we're going to establish a climate that is afraid to innovate, afraid to make suggestions, afraid to take some risks. The organizational climate is tremendously important because some of the best ideas come not from the senior management, come from the line people that work there, that see the opportunities and know the problems. Innovation and idea introduction, sure. Your industry, mine, are filled with idea introduction and innovation. R&D departments. I don't know of any banks that have R&D. Our motto is, we want to do something for the first time, but not now. That has all started to change also. R&D in industry and in manufacturing, probably the hottest thing that's going on that I'm aware of is that. Computer-aided design, computer-aided manufacturing. There's a recent article produced in Production Tool, I think is a periodical, that says there is very little economic justification for CAD/CAM. It's just that you can't afford to be without it, especially in the future as technology increases. Now this is a whole brand new area for we bankers. How do you finance these things? How do you agree with your customer? How do you become knowledgeable enough to see the benefits of this? In our own industry, for instance, our community bank at 110 East Main Street has a satellite dish on the roof. It's not for getting the World Series games. It's for getting instant real-time quotes on the New York, the American, and NASDAQ Stock Exchange. That information is filtered into a PC system that is used to make investment decisions for our clients and for ourselves. Technology, doing something differently. That's where we are. Idea introduction, being willing to take some risks. In conclusion, having tried to point out to you some of the similarities in what we're doing between manufacturing and financial institutions, between, I should say, pointing out our similarities, pointing out the differences, and giving you an idea of the transition that this industry that I represent is coming through will help you that are in manufacturing understand a little bit better, because one of the key things to any business, as you all recognize, the lifeblood is working capital. The banking industry as a whole still provides the bulk of that to industry in the form of working capital. Now, you can get along for a while if you're adequately capitalized without earnings. Not long, but for a while. But you can't go but a short duration without adequate working capital. So as you talk about financing your business, you're going to finance that with the bank, and if you understand a little bit about some of our past and some of our future and our challenges, you will have a better understanding about how we might work together to continue to finance production management. I will conclude with just one remark, and that is, in Robert Townsend's book, Up the Organization, he says, if you're going to be in business, you ought to do what you do with excellence. If you're going to be in business, you ought to do what you do and have fun. Because after all, if you're not in business for fun and for profits and for excellence, what are you doing in business? And that I would conclude for any questions that might come forward.
Jim, I had some questions here that have been given to me by some of the students and a couple I dreamed up. This will give time to those who are out there in Etherland to get on the phones, and those here students here who are going to ask some questions. But I'd like to start off that I read just recently in the Canadian Business, which is the equivalent of our Business Week of Canada, the 700 to 900 savings and loans are now have been taken over or under the auspices of the Federal Reserve System. What's going to happen to those savings and loans?
Without a lot of reliability, I would say that even though the thrift industry has had some undue pressures, principally brought about by the fact that they've got a lot of old fixed rate loans that are still on the books that finance the homes that you and I live in and Mom and Dad live in, and they're financing those with this new inventory that gets repriced in today's environment at higher prices, so you got negative margins. They've had some real problems. We all recognize that. What do I think is going to happen? I think the United States government is going to continue to prop them up and subsidize them and provide financing and funding and whatever other insurances are necessary to keep them well. You will see some consolidations. You will see some business organizational changes, and at some point I think the laws will change to allow healthy commercial banks to merge with savings and loans and perform, therefore, fewer but healthy money stores. For all practical purposes, that's where we are. When I taught out here at the university 5 years ago, I made the prediction at that point that at some point in time there would be very little, if any, difference between banks, savings and loans, credit unions, and the other financial intermediaries. That someday they will consolidate, they'll have consolidated regulatory agencies, and there'll be money stores. They'll do all things. They'll be back to department stores of finance again. The organization may look different, but they will be healthier and fewer.
A question that always comes up in my international, multinational classes, because of the global society we're now in, and of course in reviewing the way industry is financed in Japan versus the United States, where in Japan the banks supply 70% of the money and 30% is equity, while in the United States we've been just the reverse, 70% equity, 30% from banks. Do you think we're changing to follow more of the Japanese pattern?
I hope not. The country has our country has a unique system of financing business and industry, because the financial intermediaries have government support, but they're privately owned, for-profit, privately operated. England, on the other hand, I think has 3 banks for the whole country and various other options, and they're all basically nationalized, as does Canada. I don't think there's going to be a movement to that. I think the American public has looked at the way that the government has handled their fiscal affairs and said, I think maybe you ought to straighten your own house before you start managing and running the banks. And that perhaps some of the problem is we have too few business people in Congress and too many attorneys promulgating too many laws and maybe not accomplishing the mission that they were set out to do.
I'm glad you made that last comment, because when Bob Daly was here, one of the questions was, weren't there too many people of the legal mind in Congress as well as in the state legislature? And he said he was very happy as far as the Indiana state legislature, the percentage had gone down. And let's hope it happens in Congress too. I have to agree.
I would guess that you will not see ever the nationalization of the financial institutions business in this country, and I would hope not. That'd be a grim day.
One of the students wants to know if Reagan's proposed change in the Federal Reserve Board will affect banking, and how do you think it will affect it?
Well, I'm probably not really in a good position to respond to that. There have been some rumors lately, of course, about Chairman Volcker's resignation. I happen to think that that would be a serious blow to those of us that are supply-side economics supporters. I've had a few heroes in my day, most of whom have all expired for one reason or another. They were not particularly order of importance, but Spiro